Hello everyone, I hope you guys are doing great, and in today's video we would be discussing about reverse acquisition. Now this is in your CA final FR business combination, one of the most complex topics which are there. So in order to discuss that topic, we will be doing it along with the sum, which is in your ICAI study material, in your test your knowledge section, in your business combination, test your knowledge number 2, which is same as the sum in our study material in the benchmarks book at question number 71. We have a couple of additional adjustments, but for the time being, we'll focus on the institute question number 2 in your ICAI study material. I think this is page 110 of your last volume. So before we proceed on to this discussion, we will try to kind of cover this question exhaustively and in the best possible time. So hang on. So what do you mean by reverse acquisition? Reverse acquisition over here refers to a situation where the legal acquirer, that is a person who is legally obtaining the other company, becomes actually an acquiree, a target from an accounting standpoint, and the accounting and the legal acquiree or the subsidiary becomes the acquirer from an accounting standpoint. Now this is a case where your accounting has to be driven. The usual 6 steps that are there in accounting, that is identifying the acquirer, acquisition date, purchase consideration, non-controlling interest, net assets and goodwill kind of remain the same. However, everything will be flipped because what you believe is, who you believe is the acquirer is actually the target, who you believe is the target is actually the acquirer. So how do we consider that? Again, for PC, goodwill, everything. So we'll try to understand this. So let us quickly glance through the question over here. On 31st December 2021, A issues 2.5 shares in exchange for each ordinary share of B. Okay, so A is issuing 2.5 shares for each ordinary shares of B. So A is paying the purchase consideration. All of entity B shareholders exchange their shares in B. Therefore, entity A issues 150 ordinary shares in exchange for all the 60 ordinary shares of B. So the shareholders of B, let us say we give a proxy, let us say the name is Mr. B, are holding 60 shares in B Limited, and as a part of this transaction, entity A is issuing 150 shares to the shareholders of B. The fair value of each ordinary share of B as at 31st December 2021 is rupees 40, and the quoted market price of A's ordinary share is rupees 16. So you have the values for A and B shares. The fair value of entity A's identifiable assets and liabilities on 31st December 2021 are the same as their carrying amounts, except that the fair value of entity A's non-current assets are at 1500. Okay. The balance sheets of A and B immediately before the business combination are given to you. So you have the balance sheet of A, which is given to you in this question. This is a pertinent piece of information which is given to you in the question, that A is a legal parent and the accounting acquiree, B is a legal subsidiary and the accounting acquirer. This is data is given. My point is, even if it was not given, we will try to infer it. We'll go a step back and say that even if this data was not given, and in this question if you had to infer whether there's a reverse acquisition, then how will we do that? So you have the current assets, non-current assets, current liabilities, non-current liabilities, shareholders equity, retained earnings, and then 100 ordinary shares of A, which is 300, so it appears to be of rupees 3 each, let us say, and 60 ordinary shares of entity B worth 600, so this appears to be, let us say, rupees 10 each. Let us say the total shareholders equity and total liabilities and shareholders equity given. Assume that B's earnings for the annual period ended 31st March 2021 were rupees 600 and the consolidated earnings for the annual period ended 31st March 2022 were 800. Assume that there was no change in the number of ordinary shares issued by entity B during the annual period ending 31st March 21 and 2022 to the date of reverse acquisition, that is 31st of December. Calculate the fair value of the consideration transferred. So what is asked over here? We are asked to calculate the fair value of the consideration transferred, that is, I guess, PC, purchase consideration. Measure the goodwill. Okay, so this is the goodwill, and prepare the consolidated balance sheet on 31st December. So you also have to prepare the balance sheet. So if you want, just pause the video and read the question again. Typically when we start the question over here, let us say this is your ICAI test your knowledge. I'm just going to scribble down a few things. It is obviously not in the exact format. The idea over here is understanding the concept. So the step number 1 is identifying the acquirer. Now, to be honest, the question over here very clearly tells you that entity B seems to be the accounting acquirer, and hence we can directly take entity B as given. But if you wanted to kind of figure out, so this is entity B, the question tells you over here that entity B is the accounting acquirer. So we will stick to that. Entity B is the accounting acquirer, this is given. However, for reference, if you had to figure out who is the acquirer, so over here, let us say for your reference, there is entity A, and let us say the shareholders of entity A are represented by, let us say, a fictitious individual, let us say Mr. A, whereas the shareholders of entity B are represented by, let us say, Mr. B. Let's say Mr. B is the sole shareholder of B Limited, or Mr. A is the sole shareholder, for example, of A Limited, for simplicity. Now, as per the given data, Mr. A is owning 100 equity shares of A Limited and Mr. B is owning 60 equity shares of B Limited. Now, as per the legal arrangement, entity A is approaching Mr. B and is acquiring all the 60 shares of B. So, all the 60 shares of B are acquired by A Limited, and as a result, over here, A Limited will issue to Mr. B 150 shares of A. Now, how did this 150 share arrive? If you see the question, it says every share of for every share of B, you are issuing 2.5 shares of A. So, basically 2.5 into 60 will actually give you 150. Basically, that is given to you. Now, as a result of this transaction, what will happen? Now, post acquisition, entity A will acquire all shares of entity B. So, legally, post acquisition, on a legal setup, you will have entity B, let us say we call this as B Limited, and above that there will be entity A, we call this as A Limited. Now, by acquiring 60 shares of B, as you can see over here, entity A acquires all the 100% stake in B Limited. So, over here, all the 60 shares of B are held by A Limited, and hence A Limited has 100% of entity B. However, who is now controlling, or who is sitting behind A Limited? Who is sitting behind A Limited? Well, A Limited continues. There is a Mr. A who continues to have 100 shares in A. Now, in A Limited, originally there were 100 shares, but as a part of this transaction, you also issued another 150 shares, and hence now, post this transaction, there will be, let us say, 250 shares in A Limited, out of which 100 shares continue to be held by, let us say, the shareholders of A, that is Mr. A, whereas the remaining 150 shares are the new shares which are issued to the new shareholder, that is Mr. B. Now, this 100 share represents what? Well, it represents 100 out of 250, and hence it represents a 40% stake. So, Mr. A now owns a 40% stake in A Limited, whereas this 150 shares now represents 150 out of 250, and as a result, this represents, let us say, 60% stake. And as a result, over here, this is 60%. So, what is happening now is pre-combination and post-combination. When I look at A Limited and when I look at B Limited, now pre-combination, the business of A was controlled, let us say, by Mr. A. Pre-combination, the business of B was controlled, let us say, by Mr. B. Now, what is happening is post-combination, the business of A is now controlled by Mr. B. So, there is a transfer of control happening for A, whereas the business of B is going to be controlled by A Limited. However, A Limited is ultimately controlled, A Limited is basically ultimately controlled by Mr. B, and hence we will say that the control of B Limited, the business of B Limited is still continued to be controlled by Mr. B post the acquisition, whereas the business of A Limited is now controlled by Mr. B, and hence over here there is transfer of control. Therefore, there is transfer of control of A Limited, and hence we can say that over here A Limited refers to the accounting. From an accounting perspective, it is the acquiree, it is the target. From a legal perspective, it can be the acquirer, let us say. However, from an accounting standpoint, it is a target. In a similar way, B Limited, from an accounting perspective, appears to be the acquirer. Though legal perspective, it appears to be the acquiree. This is what is given to you in the question, and hence you don't need to do so much of detailing, at least in this question. However, it is good to know that this is how you can kind of infer. This is the first step. The second step typically is determination of the acquisition date. Now over here, this transaction is happening on 31st of December 20x1, and as a result your acquisition date seems to be 31st December 20x1. No hidden adjustments here. Now the third point is the tricky point. This is the calculation of purchase consideration. Now if I look at the legal form only, considering the legal form, it appears that the consideration is paid, that is 150 shares. Sorry, this is 150 shares of A. So it appears that A Limited is paying 150 shares of A to Mr. B, and hence the PC appears to be, like in every other question, this should be shares issued. Over here, the PC will be in the form of shares issued. So over here, it appears that 150 shares of A are issued to Mr. B, and every share of A is, let us say, worth 16. So this is the quoted market price of A, and as a result, it appears that 150 into 16, that is 2400, is the purchase consideration. Now this is incorrect. This would have been correct in case of a normal acquisition where entity A is acquiring control over entity B. Why is this not correct over here? It is because this 150 shares are issued to Mr. B, who is the owner of the purchasing company. One should remember that PC refers to the payment that you are making to the owners of the selling company. B Limited is not the selling company, and hence 150 shares which are given to Mr. B cannot reflect the PC, because it is actually, from an accounting standpoint, a payment which is made to the owner of the purchasing company. But PC refers very clearly to the payment that you make to the owners of the selling company, and hence this cannot be PC. So this is not PC, first of all. Okay, so if this is not PC, then what is PC? Now some students say that, okay, if 150 shares is not of A is not PC, we'll take 60 shares of B. Array, it is a part of the same transaction. 150 shares in A actually is equal to 60 shares of B. So if you do your calculation, 60 shares of B and every share of B is worth 40 rupees, then 60 shares of B into 40, that is 2400. It is one and the same. Kaan सीधा के बदले अपने उल्टा पकड़ा. It is one and the same. It cannot be PC. Neither of these is the PC. Then what is PC? Well, PC refers to the payment that you will make to the owners of the selling company, that is Mr. A. Payment that is going to Mr. A. Sir, but Mr. A, there is no payment going. Okay, there is no payment going in a legal transaction. However, we build up a hypothetical, a notional transaction. So we ask ourselves that, okay, the transaction is structured as if it is a acquisition of entity A acquiring entity B. However, in substance, in essence, it is a transaction where, let us say, entity B is acquiring entity A for whatever reasons. Currently, we are focusing on the accounting. So over here, when we are looking at the accounting part, we will say that had this been a normal acquisition, so hypothetically, if the transaction was structured as a normal acquisition with entity B acquiring control over entity A, then what will be the position? If the transaction, this is the transaction which is from an accounting standpoint, so your accounting should happen considering entity B is acquiring control over entity B. So over here, let us say there is a Mr. A, let us say there is a Mr. B. As given, Mr. A is owning 100 shares in A Limited. There is a Mr. B who is owning 60 shares in, let us say, B Limited. And if this was a normal transaction, then B Limited would approach the shareholders of the selling company, that is A, and B Limited would issue PC. PC for what? Well, we would acquire all the 100 shares. So over here, B Limited would acquire all the 100 shares of A and in return issue the actual PC. In return issue the PC. Now the question arises, what will be this PC? So over here there are 2 or 3 ways in which you can come to the same conclusion. So over here we don't know because the legal transaction is not this. There is some shares of B that you will issue. This is PC. How do you strictly define PC? PC is a payment that you make to the owners of the selling company. A Limited is a selling company, owner is Mr. A, so the payment that goes to Mr. A should be the PC. However, we don't know how much should be the payment that should go to Mr. A, and hence there are 2 or 3 ways in which you can find. All of these will give you the same answer. The first way would be you look at the exchange ratio. So we know that the exchange ratio, the exchange ratio between A and B is 2.5 shares of A for every 1 share of B. So in this case, if we acknowledge that 1 share of B is worth 2.5 shares of A, then over here, how many shares should you issue? Well, entity B is acquiring 100 shares of A, and for 100 shares of A, each share of B is worth 2.5 shares of A, and hence 1 upon 2.5, and hence we will issue 100 upon 2.5, that is equal to 40 shares of B. Again, for 2.5 shares of A, I would have issued 1 share of B. So for 100 shares of A, I will issue how many shares of B? So this should ideally be 40 shares of B. Alternatively, another school of thought or another thought process that you can apply is, we have understood that post acquisition the commercial understanding is, now hypothetically it may not necessarily be the case, but if you are aware, there was Vodafone and there was Idea. They came together and formed a company, V Limited. So let us say over here Vodafone was a bigger company, Idea was a smaller company, but since Idea was listed, let us say Vodafone was, in a way, this is again a hypothetical example where Vodafone, let us say, comes along with Idea, and in the post combination entity, now Idea shareholders only own 40% and Vodafone shareholders own 60%, in which case the business which was earlier controlled hypothetically with Vodafone continues to be controlled by Vodafone, and the new business of Idea, which is now also controlled by Vodafone. So over here we are trying to say that legally, whatever be the arrangement, accounting wise, if it was structured as a normal transaction, then how would or how many shares would you issue? Well, we first have to take the exchange ratio, which in my opinion is the easiest way. The second way over here is to say that commercially we are clear that in the post combination entity, B's shareholders should be owning 60% and A shareholders should be owning 40%, and hence ideally if I were to go ahead and do this transaction where entity B was the legal acquirer as well as the accounting acquirer, so entity B over here is the legal and accounting acquirer, in which case entity B would take over all the 100 shares of entity A, and as a result over here entity B will now own 100%, that is all the 100 shares of A entity B would own, and as a result it would obtain control over A. However, commercially my understanding was clear. Well, there is 60 shares originally plus an X number of shares which will be issued to the shareholders of A. We don't know. I mean, in my opinion 40 is clear, but an alternative route would be, well, we don't know how much would that be. However, we know that Mr. B commercially post acquisition is going to stick on a 60% stake. This is commercially agreed that Mr. B is going to have a 60% share in the post combination entity, which means 60 shares that Mr. B is going to own is equivalent to 60% stake. Then who is going to own the remaining 40% stake? Well, Mr. A over here is going to own the remaining 40% stake. Then 40% stake will be how much? Well, if you do a cross multiplication exercise, again, if 60% is worth 60 shares, then 40% is worth how much? Well, we will get 40 shares, the same answer of 40. That is, entity B will issue 40 of its own shares to the shareholders of entity A, and as a result over here this should come to 40 shares. So one way in which you can calculate PC, again in this case, and this is how the accounting will happen, entity B is acquiring 100% of entity A, therefore in entity A, B owns 100%, in which case non-controlling interest in entity A is actually 0% on considering the legal and accounting acquisition to be the same, because accounting is happening considering that. So over here, one of the ways to calculate PC would be, so PC over here can potentially be calculated using alternative 1, where we say that PC refers to the payment made to the owners of the selling company. 40 shares of B are going to be issued to the shareholders of A, and each share of B is worth 40 rupees. This is the fair value of each share of B, and hence rupees 1600 should ideally be the PC. This is one of the ways in which you can calculate the PC. However, a much more easier way is possible in my opinion. I'm just explaining you everything which is there in the study material. In the exam you can directly take as well. A much more easier way is, well, PC should ideally be the consideration that you are paying. But if the consideration that you are paying is not easily determinable, like you even do this in case of barter, if the consideration that you are paying is not easily determinable, then you can say that what you are receiving, if you are receiving 100 shares and each of this 100 share is worth 16 rupees, then what you are paying must also be worth the same. So over here, we will say that the number of shares that we are issuing to the shareholders of A, in return of that, we are getting 100 shares of A. So what is the value of 100 shares of A? So over here, another alternative would be, well, as a part of the same transaction, on one hand, I'm giving 40 shares of B hypothetically, and on the other hand, I'm getting 100 shares of A. So what is the value of 100 shares of A? So this is 100 shares of A that I'm receiving, against which I'll give some PC. If nothing is given, I will assume that if I'm receiving something worth 1600, I must also be paying something worth 1600. So this is 100 shares of A into rupees 16, which is the quoted market price of A, which by the way is the same. This is 1600, and hence the PC should be 1600 in either of these two cases. Now if you want to dig down even deeper, you have to say that yahan pe it is same. Hypothetically, if this was different, which of the two would you have selected? Well, Ind AS 113 applies over here, the standard on fair value measurement, which says that if you have to select between two valuation techniques, you will select the valuation technique which maximizes the use of observable inputs and minimizes the use of unobservable inputs. So over here, rupees 16 is based on the quoted market price of A, which is a level 1 category input, whereas 40 rupees is a fair value which is not quoted market price, and hence it's not level 1 category, and hence over here this 1600 will be taken as per Ind AS 113 fair value measurement hierarchy, and hence whatever be the reason, in this case you are taking 1600 rupees as PC. The more important thing to gauge over here is the PC is a payment to be made to the owners of the selling company. A Limited is the selling company. Owners of A, that is Mr. A, are going to effectively get 100, are effectively going to get 40 shares of B, which is worth 40 into 40, that is 600, which is equivalent or which is against the 100 shares that they own, which are worth 16, so that is 1600. So the first part of the question asks you to calculate the fair value of the consideration transferred. This will be 1600. The first part of the question, 1600. Second, measure the goodwill. Now, how do you calculate goodwill? Goodwill is the purchase consideration plus the non-controlling interest minus net assets will give you goodwill. The purchase consideration, listen to this carefully, the purchase consideration is the payment that you are making to the owners of A Limited in regard or in consideration of getting the net assets of A. If you are taking the PC as payment made to A, you should take the net assets of A over. So over here, entity A is the target in which we are owning 100% stake. So NCI has a 0% stake. If I consider, remember, your entire transaction is happening as if this entire set of things on our second slide is actually happening. So over here, you have PC. The next step over here is calculation of net assets. Remember, these are net assets of A, which are taken over. Why? Because it is structured as a transaction where B is taken over A. If B is taking over A, you will take over the assets and liabilities of A at fair value, not the assets and liabilities of B. Secondly, the PC's payment made to the shareholders of A, so net assets as a comparison should be the net assets of A taken over. So when I take the net assets of A, you have current assets. Well, if nothing is given, the fair value is equal to the book value. However, for non-current assets, a fair value is separately given. So over here, for current assets, nothing is given. So we will take 500. However, for the non-current assets, you have been given that the fair value, let us say, is 1500. The book value might be 1300. However, assets and liabilities have to be taken over at fair value, which is 1500. Liabilities, current liabilities and non-current liabilities. So over here minus the current liabilities, which are worth 300, I guess, and the non-current liabilities, which are worth 400, I guess. And hence, your net assets which are taken over are going to be what? 1500 and 500 less 700, and hence this is 1300. This is the net assets of A which are taken over. Will we take over the reserves as well? No, this is not a common control combination. This is not pooling of interest method, and hence the reserves of A are not taken over. Acha. Is there any non-controlling interest over here? Remember, your accounting will be considering this transaction only. Non-controlling interest is always calculated as a percentage of the target company which is held by shareholders other than the parent. Here, B, who is a parent, owns 100% and no one else in this accounting setup owns anything, and as a result NCI over here is, let us say, 0%. In which case, if you want to calculate the goodwill over here is calculated as a purchase consideration, which is, remember, purchase consideration is against 100% of the stake. Remember, PC, for calculation of PC, you have taken all the 100 shares that are there in A, you have taken them over. You are acquiring all the 100 shares in A, and as a result, your PC, which is for 100% stake, is 1600, NCI is 0, and minus the net assets, you will take over 100% of the net assets as well, which are worth 1300, and hence the second step involves the calculation of goodwill. The goodwill over here is, let us say, 300, and this goodwill will appear in the final balance sheet. Now, the question further asks you to measure goodwill, and the goodwill over here is, let us say, 300. And prepare the consolidated balance sheet as on 31st December 20x1. Now, if you want to prepare the consolidated balance sheet, you need to remember a rule which is there for the purpose of preparing the consolidated balance sheet. Remember, the rule says that you will prepare the balance sheet as if it is a continuing financial statements. So, in case of a reverse acquisition, you prepare the balance sheet as if it is a continuing financial statement of the accounting acquirer. That is B. What do you mean by continuing financial statements of the accounting acquirer? Continuing financial statements of the accounting acquirer means that the reserves of B will continue. Reserves of B will continue. It is continuing financial statements, plus the net assets of B will be continued at their corresponding book values only, which means your reserves of A will not be taken over, because this is continuing financial statements of B, so reserves of A are not taken over, and net assets of A, like in an acquisition, are taken over at fair value. So this is taken over at the fair values. In a normal acquisition, what happens? You don't take over the reserves of the selling company, you take over their assets and liabilities at fair value. So over here, it is as if it is a continuing financial statements of B, and hence B's assets and liabilities will continue at their book values, B's reserves will continue as it is, and we will take over the assets and liabilities of A at their fair values. Reserves of A will not be taken over. However, at the end of the day, you have to prepare the balance sheet in the name of A, because legally A has issued the shares. You have done all of this hypothetical setup that 40 shares will be issued and this, but in reality 40 shares have not been issued. So over here, this will be in the name of the legal acquirer, because the number of shares would be ideally shares of entity A. This is where the twist arises. Now, there are various ways in which you can solve. Institute has done the direct way, which is the easiest way. However, students who think through a lot kind of come with the problem that how will that be reflected. Again, remember, Institute has done a direct way. We will first do it the way Institute has done this, and we will then figure out that if you want an additional layer of presentation, then how will you do presentation, how will your accounts tally, etc. So over here, if you were to go ahead and present, let us say this is the consolidated balance sheet. I'm just doing this in rough. Consolidated balance sheet as at 31st December 20x1. Now, ideally, this should be B who is acquiring. Forget this rule. If this rule was not there, then accounting wise, B is acquiring A, and hence ideally it should be in the name of B Limited and its subsidiaries, ideally B Limited and its subsidiaries whether it will be the case or not, वो अपन आगे देखेंगे, but it should ideally be in the name of B Limited and its subsidiaries because B is acquiring A. And hence, if you do the working, this is, let's say, particulars, this is, let's say, rupees, whatever, lakhs, thousands, whatever that is. So we will take that into consideration, and then we will start. Let us say we will start, loosely speaking, with assets. Within assets, you will go to non-current assets. Non-current assets will constitute assets of B plus assets of A. So assets of B are 3000 continuing, and A you will take at 1500. So this is 3000 of B plus 1500 of A, and hence there is no other adjustment. So this will appear at 4500. Apart from that, there will be goodwill which will arise as a stage of business combination. Again, this is goodwill as if B has acquired A, comparing the PC that you paid to A shareholders with the net assets of A. So that goodwill, as per our working, comes to 300. Now apart from that, there is current assets. Current assets, you don't have a separate fair value, so you will take 700 and 500. So this is 700 for B plus you will add 500 of A, and hence this is 1200. There does not seem to be anything else on the asset side, and hence if you total up, then comes a problem. You go into the equity and the liabilities side. When you go to the equity and liabilities side, the first item that you have is equity. Now within equity, you should actually have the equity share capital. Now ideally what would have happened? Ideally what would have happened is, if this financial statements were prepared in the name of B, then there would be equity share capital of B, which is 60 shares of B. Against this 60 shares, another 40 shares of B have been issued at the rate rupees 40. Remember the face value. The face value of B share is 10 rupees and the fair value of B share is 40 rupees. You are issuing actually 40 shares of B, whose total consideration comes to 1600 at the fair value of rupees 40 each, which means 30 rupees will, strictly speaking, go to the securities premium. I am doing this as if this was a normal acquisition. So this is 60 shares plus 40 shares. Now apart from that, there will also be what you call as a securities premium. So over here we will say that 60 shares of B which were already there, which is worth 600, 60 shares into rupees 10, that is 600, and then another 40 shares issued. Everything is worth rupees 10 each, and hence the total over here will come to, let us say, 600 plus 400, that is what, 1000. And in your securities premium, you will have 40 shares, and each of these share is worth rupees 40 minus rupees 10, and hence each of these share is having a premium of 30 rupees. So this comes to, let us say, 1200. So basically the total of this will be 2200. One way or the other, the total will be 2200. Now what ICAI has done over here is, ICAI has said that at the end of the day, you know what is going to happen? You have 600 rupees of B share capital that has to appear. There is purchase consideration that is issued which is worth 1600, and hence that has to appear, and hence if your balance sheet has to tally, then to the 600 share capital that is already there, there has to be a 1600 PC that is to be added, and hence we will take 600 plus 1600, that is equal to 2200, which we are also getting. Apart from that, will there be any reserves? Well, yes, there will be retained earnings. Now this retained earnings is a problem. What will you do? Can I add the retained earnings? Can I add the retained earnings of A and B both? Well, since the financials represent continuing financial statements of B, it is as if B is taking over A. So the reserves of B will continue. A's reserves will not be taken over as per purchase or acquisition accounting, and hence this will be retained earnings of B and B alone. No problem over here. Apart from that, there are a few other liabilities. Let us say the non-current liabilities, which will include the non-current liabilities of B, which is 1100, and of A, which is 400. So this is, let us say, 1100 plus 400, which comes to, let us say, 1500, and the current liabilities, which is 600 and 300. So this is, let us say, 600 plus, let us say, 300, which is what, 900. Now when we are looking at the balance sheet now, should the balance sheet tally? Remember, this is a balance sheet which is a continuing statement, that is B acquiring A in the name of B Limited. So if I take the balance sheet, this is 4500 and 1500, so this is 6000 and this is what, 2200, 1400, and I think 2400, and bang on. This is 6000. Ideally, this story should have had a happy ending at this point. However, it does not. Why? Because here to the reader, you are presenting a picture which is hypothetical. You are telling the reader that legally also B has acquired A, whereas as a matter of fact, it has not. There is a fiction appearing on the balance sheet of 40 shares. The shareholders will be scrambling. Where are the 40 shares? Because actually there is no 40 shares which are issued, and hence the method says you should actually prepare this in the name of the legal acquirer. So over here it will not be in the name of B Limited, it will be in the name of A Limited and its subsidiaries. However, it will represent continuing financial statements of the accounting acquirer, that is B, but it will be in the name of A. Now if it is in the name of A, it has to have shares of A, and hence you cannot take this 60 shares plus 40 shares of B. Obviously the securities premium is also the securities premium arising on B shares. If you cannot have shares of B, you can't even have the securities premium of B. This is where the challenge arises. The replacement over here is something which makes matters worse, and more so because Institute has taken a fairly simple direct approach which you can even take in the exam. So I've just explained fundamentally why should the balance sheet have tallied. If I had taken all assets and all liabilities of B, reserves of B continues, and 600 was the share capital of B, to which you add whatever is the purchase consideration to be issued, so the balance sheet would have tallied. However, because you are required to make this in the name of A, because if you prepare it in the name of B, you have to show the shares of B, against which you are showing 40 shares of B, which in reality have not even been issued, and hence we prepare it in the name of A. But if you prepare it in the name of A, you have to show the shares of A. So this will become a mess. And as a result, what Institute has done over here is that it has said that ultimately this 2200 should appear. So they have taken a fairly easy route out, where they have said that at the end of the day, the amount that should be appearing in the equity section will be 2200. Now, how did this 2200 come? Well, 2200 is 600, which was the share capital of B, plus we have said that 1600 is the PC. A part of the 1600 will be towards the share capital, a part of it may be towards the securities. Remember, at the end of the day, it will be a part of overall equity, and as a result, this will be 2200. That's it. It has to happen. That is when the balance sheet will tally. Otherwise, it will not. And hence the question ends over here. However, if you want to kind of figure out how will this be presented, the Institute explains that as a paragraph. We will refer that. But how will this be presented? In my opinion, and I'm open to suggestions, and it would be great if you can also add your inputs, because there's no standardization over here. Even in international material, this is the only example which by and large is floating around. So what will happen is we have to show the shares. So ideally, when you prepare the note on the share capital, let us say if you are preparing the note on the share capital, this has to be in A's shares. Now A legally had 100 shares, and legally officially A issued another 150 shares. Now accounting wise you might assume anything, but legally A had 100 shares and A issued another 150 shares, and hence we had 250 shares. So you have 250 equity shares of A Limited at the rate rupees 3 each. Now how did we get rupees 3? Because your existing shares of A appears to be 3 rupees each. So this is 100 shares, 300 rupees. So it appears that each share of A is worth 3 rupees. There is nothing wrong in that. In which case 250 shares of A at the rate 3 rupees, which means your share capital should ideally appear at 750 rupees. Now, can you take the securities premium on the issue of this 150 shares? The answer is no. Why? Because you're taking the reserves of B only. You can't take part of the reserves of B and part of the reserves of A. That is not possible. You are taking the reserves of B only, and hence the continuing reserves will be reserves of B, which is 1400, which is the retained earnings of B. 150 के ऊपर अगर कुछ premium है, then that premium refers to the premium issued and included in A's reserves. You are taking only the share capital of A. The reserves, etc., continue to be that of B. Now this is where a fairly weird thing is happening, where you are removing from the balance sheet 1000 and 1200 and instead substituting something as 750. Now what you are doing is you are removing 600 of share capital of B plus 1600, which is the total PC, that is 2200, and in return legally superimposing share capital of A. Now to expect that a balance sheet will tally in such a situation is miraculous. It will not tally. Why? Because you are taking out the share capital and PC of B and substituting some other company share capital. How on earth is it going to tally? It will not tally. And it is not tallying because you have done this reverse acquisition adjustment. If you remember in your CA Inter, when you did branch accounts or AS11 or even in CA Final, when you calculate for a foreign branch, what happens is generally the trial balance of the foreign branch tallies in the foreign currency, in dollars, let us say. However, you apply different rates, certain items closing rate, certain items historic rate, certain items average rate. Will your trial balance or balance sheet in rupees tally? No, it will not. Why is it not tallying? It is not tallying because you are applying different rates to different items. If you applied the same rate to every item, the rupee trial balance would have also tallied, and hence the difference in the trial balance or in the balance sheet, as the case may be, is attributable to something called as foreign currency translation reserve, that is FCTR. In a similar way, here, ideally, in your balance sheet where B is acquiring A, B share capital of 600 would have remained, and then B issues a PC of 1600 which would have been added. Considering that 2200 should be there in the balance sheet. Now you are removing that 2200 and superimposing a number 750. Now your balance sheet is not going to tally. So why is it not tallying? It is not tallying because you are removing 2200 and in return putting only 750, and hence the balance over here can be put into a temporary account, like in AS11, Ind AS 21, you put it into foreign currency translation reserve, FCTR, or in amalgamation where you have a statutory reserve, you create an amalgamation adjustment account. In a similar way, you can prepare a reverse acquisition adjustment account. Again, the nomenclature may differ company to company and there can be alternative presentations as well. However, for the sake of academic completion, we can say that okay, there will be, ideally I have to show a total of 2200 for my balance sheet to tally, that is 600 in rupee terms plus 1600, which is the consideration issued. So this has to appear. However, that can be represented by 750 in the form of equity shares in A because you are showing it in the name of A, which means the remaining over here will be attributable to a temporary, what you call as a reverse acquisition adjustment. Till when will you continue? Well, the time the reverse acquisition is effective. Reverse acquisition adjustment account, which will possibly be the difference between the two, that is 2200, which should have been there, and you are superimposing only 750, and hence the difference over here can be treated as 1450 into a temporary account. And again, I'm open to getting your views over here as well, because Institute has not really been loud and clear on how the treatment should be. One thing is very clear, ultimately 2200 should appear. So this will be your final balance sheet. This is how your final balance sheet will appear. You will not have any of these. In fact, as per ICAI solution, you will show a combined equity, basically keeping retained earnings separately, of 2200, which if you want to show as a breakup will be shown as shares of A, and because you are removing the shares of B and the PC and putting just shares of A, the difference in the balance sheet is attributable to a reverse acquisition adjustment account, a temporary account. So what does ICAI do over here? If you refer the solution, almost everything is exactly as we have done. However, when you look at the balance sheet on page number 13.122, what they do is shareholders equity. Within shareholders equity, they say issued equity 250 ordinary shares, directly 600 plus 600. 600 is the share capital of B plus 1600, which is the purchase consideration, and hence this comes to 2200. They directly take 2200. They do not give a breakup over here, and in the notes they mention the amount recognized is the issued equity interest in the consolidated financial statements. 2200 is determined by adding the issued equity of the legal subsidiary immediately before the business combination, that is 600, and the fair value of the consideration effectively transferred, that is 1600, because you are taking over the net assets. What is happening is in the business combination entry, you take over the net assets which are worth 1600. You are recording the goodwill. You are taking over the net assets worth 1300. You are recording the goodwill of 300. So सामने 1600 का PC तो देना पड़ेगा. You have to show that consideration. However, the equity structure appearing in the consolidated financial statements, that is a number and the type of interest issued, must reflect the equity structure of the legal parent. Legal parent is A, including the equity interest issued by the legal parent to effect the combination. So over here they say, however, the equity structure appear in the CFS, that is this note that you have to show in the CFS, should reflect the number and the type of equity interest issued, they must reflect equity share of the legal parent, that is A, including the interest issued by the legal parent to effect the combination. But if you take that, instead of 2,200, the balance sheet is not going to tally, so the difference over here will be kept into a temporary reverse acquisition adjustment account, and the explanation for all of this should ideally be explained at length in the notes. Okay, so from the institute material, this is where the institute solution kind of ends, because these are the three things asked. I hope this video has been helpful to you in at least resolving some of the conceptual areas for reverse acquisition. It is a fairly complicated topic. You should really not spend way too much time, because there are a couple of sums in the material based on this, and it is likely that if a question comes, it will be on similar lines only. So try to get your arms around this, understand it, and please ensure that you don't leave this, because this is one of the very few areas of business combination which till the time of recording this video has not come in your exam. Every other big question, like you have those professional dynamic type of questions, or even that AX, BX, ABX type of questions, etc., these have almost all come. So it is high time that the institute might potentially test for this, and hence do not leave this. Yes, understanding this requires some bit of peaceful time to be invested, but ensure that you don't leave this. Cover this, understand this, and proceed. Okay, chalo. That should be then. Please do like the video if you have enjoyed it, and let me know in the comments if you need anything else. We'll try to address that as well. Have a good day. Bye bye. Take care.